Welcome back to Investing Talk podcast.
Today we're looking at Rivian Automotive. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Rivian's been, well, quite the story, hasn't it?
Absolutely. A lot of buzz, a lot of volatility. So where do we start? Maybe the operational side. What are the bulls focusing on?
Right, the operational momentum is key. For a company like Rivian, it really boils down to, can they make the cars efficiently and scale up?
And the latest numbers suggest they're getting better at it.
Exactly. If you look at Q3 2025, they produced 10,720 vehicles. But what's really interesting is they delivered 13,201.
Oh, delivering more than they produced in the quarter. That sounds positive. Clearing inventory?
Yeah, it suggests demand is strong and they're managing that flow effectively. It's a good sign.
And that led them to raise their full-year guidance too, didn't it?
It did. They bumped up the 2025 delivery forecast. Now they're expecting between 41,500 and 43,500 vehicles.
So management's feeling pretty confident about hitting those targets, despite, all the supply chain talk we always hear.
Seems like it. That upward revision is definitely a bullish signal from them.
And how does that translate into revenue? Because deliveries are one thing, cash is another.
Good point. So Q3 revenue came in at $1.3 billion. Solid number.
And the bigger picture, trailing 12 months.
If you look at the TTM, the trailing 12 months, revenue is now over $5.15 billion.
Wow, okay. So even with the challenges, that's serious growth from a standstill not too long ago.
Absolutely. It shows the speed, the velocity of their ramp up. It's impressive. You can't deny that.
But Rivian's whole angle wasn't just about being another EV company, right? They aimed for something different, their niche.
Precisely. That's their competitive mode, really. They aren't going head-to-head with Tesla on mass-market sedans or Ford on, standard work trucks.
They're after that adventure lifestyle crowd with the R1T pickup and the R1S SUV.
Exactly. It's a premium segment. Think higher price points, customers may be less sensitive to economic dips, people who want that specific capability and design.
And that niche is less crowded.
For now, yeah. In the high-end electric adventure space, they've carved out a really strong position. It's built on the brand as much as the vehicle specs.
And they're trying to carry that forward with the R2 platform that's coming up.
That's the plan. We've seen some details, like safety redesigns for the R2. It shows they're learning from the R1 and aiming for perhaps broader appeal within that premium feel.
R2 is crucial for their next phase of growth, isn't it?
Oh, absolutely. It's how they potentially scale volume significantly while trying to maintain that brand cachet. Big test coming up.
We should also touch on the commercial side. The Amazon deal, that seems like a huge stabilizer.
Huge. It provides a baseline demand. That partnership is foundational.
And it's expanding, right? I saw something about Canada.
Yeah, they recently expanded the electric delivery van fleet into Canada. Amazon's commitment means Rivian has this guaranteed order flow, which helps buffer against, swings in consumer demand.
That's got to be helpful for planning and, frankly, for funding everything else they're doing.
Definitely. It's a critical financial backstop for their expansion plans.
Okay, so strong operational signs, unique market position, solid commercial partnership. But let's pivot to the elephant in the room, profitability.
Right. This is the financial tightrope. It's the core challenge for pretty much any growth EV maker right now.
And the numbers. They still look pretty rough on the surface.
They do. I mean, gross margin in Q3 2025 was still negative 4.3%.
Oof. Still losing money on each car sold before even considering R&D and other costs.
Exactly. And the EBIT margin, earnings before interest and taxes, that's even starker, negative 65.1%.
Wow. So huge cash burn. Why? Just the cost of scaling up so fast.
Primarily, yes, massive capital investments, building factories, developing the R2 platform. It all costs a ton up front. So free cash flow is still deeply negative.
That sounds, concerning. But you mentioned earlier the trend might be the more important story here.
That's the bullish counterargument, yes. You can't just look at the negative number in isolation. You have to see the direction of travel.
So how much better are things getting year over year?
Significantly better. The consensus forecast for Q3 loss per share was around negative 72 cents. That's actually a 30% improvement compared to the loss in Q3 of the previous year.
Okay, so narrowing the loss considerably.
Right, and for the full year 2025, the forecast is a loss of about $2.73 per share. Again, that's roughly a 32% improvement year over year.
So the gap is still big, but they are closing it. That's the narrative.
Precisely. They're making strides towards profitability faster than some might expect, given the scale of their investments.
Closing that gap takes more than just building more cars, though. It needs financial discipline, right? Cost management.
Absolutely. And we've seen management take steps there. Remember back in August 2025, they had that layoff? About 4.5% of the workforce.
Yeah, I remember that. Was that seen as a panic move or more strategic?
More strategic, I think. It seemed like a response to maybe a slightly softer EV demand outlook globally, signaling a shift towards, okay, let's manage costs carefully now, not just growth at all costs.
And they've been active on the debt side, too, dealing with notes coming due soon.
Yes, that's a really smart move they're making. They have debt due in 2026, which isn't that far away when you're burning cash.
So what's the plan?
They're planning to raise $1.25 billion in new senior secured notes, but these ones are due way out in 2031.
Ah, okay. So use that new longer-term debt to pay off the nearer-term stuff.
Exactly. It pushes their major debt obligations further down the road, gives them crucial breathing room, more time for R2 to ramp up, and hopefully start generating positive cash flow before those notes mature. Very important for their financial runway.
Makes sense. And didn't they clear up some legal trouble recently, too?
They did. There was a $250 million class action lawsuit hanging over them. They resolved that.
Which must be a relief. Takes away a big chunk of uncertainty and, well, legal fees.
For sure. Reducing that legal liability risk lets management focus squarely on execution R2, manufacturing, instead of being distracted by litigation.
Okay, so operationally improving, financially getting more disciplined, clearing legal hurdles. Yet there was that wobble in October, the insider selling.
Yeah, that definitely caught people's attention.
Yeah.
The CEO and CFO selling shares, collectively over 24,000 shares.
Which never looks great, does it? People immediately ask, why are they selling if things are looking up?
It always sparks concern, no doubt. It makes retail investors nervous. But you have to add context.
Like what?
Well, while the execs sold some shares maybe for personal financial planning, who knows the big strategic holders aren't bailing. Amazon still has a massive stake.
Right. Their biggest customer and partner isn't heading for the exits.
Exactly. So institutional conviction, especially from Amazon, seems strong and long-term. That kind of balances out the nervousness from the insider sales, I think.
Okay, that's a good overview of the fundamentals. What about the technical picture, the stock chart itself?
Right, so moving to the technicals, the price action recently has been quite interesting. It closed October at $13.57.
And what does that tell technical analysts?
Well, that price action actually confirmed what looks like a near-term bullish reversal. We're seeing a pattern of higher lows being established.
Higher lows, meaning the dips aren't going as low as they used to, suggests buyers are stepping in sooner.
That's the idea. And significantly, the price crossed back above its 50-day moving average, which was sitting around $12.50.
And crossing the 50-day is often seen as a bullish signal, right? A shift in momentum.
It is. For technicians, it suggests short-term pessimism might be fading and confidence could be building, maybe in anticipation of good news.
But we have to mention the volatility. This stock jumps around a lot.
Absolutely. You need a strong stomach for this one. It's traded in a wide range recently, call it roughly $9.50 up to $17.15.
And the beta confirms that volatility.
It does. The beta is high, around 1.83.
Meaning if the market moves 1%, Rivian tends to move about 1.8%. So amplified swings in both directions.
Precisely. High risk, high potential reward. Given the recent technical signals, though, the outlook seems to favor a trading range perhaps between $13 and $17 in early 2026. But again, expect significant bumps along the way.
Okay, so fundamentals improving, technical suggesting a turn. What are the immediate triggers? The catalysts that could drive the stock in the next, say, 0-3 months? Why now?
The big one, right around the corner, is the Q3 2025 earnings release. That's scheduled for November 4th.
And what are people looking for there? Just confirmation of the trends we discussed?
Pretty much. Confirmation of that year-over-year improvement in EPS loss, confirmation of the revenue growth, a solid beat on expectations could really ignite the stock, push it towards that $17 level.
Beyond earnings, it feels like everything revolves around the R2.
It really does. The R1 established the brand, but R2 is supposed to be the volume play, entering a larger market segment.
So any news is good news?
Almost. Continued pre-marketing buzz, any positive updates, and especially the actual unveiling of the R2 model. These are huge catalysts. Every little hint about pre-orders or timelines fuels retail interest.
And then there are potential external factors, policy stuff.
Yeah, keep an eye on Washington.
Yeah.
There's anticipation about final clarification on White House tariff relief policies.
How would that help Rivian?
If the policies favor domestic EV production, which Rivian certainly is, it could directly boost their margins. like overnight. Without them changing anything in the factory, that would be a significant tailwind.
Okay, those are the concrete things. Now, the fun part, the rumor mill. What speculation is swirling around?
Ah, yes. With stocks like this, there's always chatter. One persistent rumor is about Volkswagen.
Expanding on their existing partnership. They already committed billions, right?
$5.8 billion, yeah.
Yeah.
The speculation is that VW might escalate that, maybe more capital, maybe deeper collaboration on tech, charging. If that happened, it would be huge validation.
What else? Anything about the R2 timeline?
There's some buzz, unconfirmed of course, about potentially revealing the R2 SUV earlier than expected.
That would be a big psychological boost, wouldn't it? Suggesting they're ahead of schedule.
Definitely. It would signal strong execution on their development cycle.
And the perennial rumors, strategic tie-ups.
Always. Whispers about legacy automakers looking for an EV partner or maybe a foreign strategic investor. You hear names floated, Middle Eastern funds, South Korean conglomerates, often looking for long-term tech access.
If any of those rumors became reality,
The stock reaction would likely be dramatic, potentially pushing it well beyond current analyst targets. But again, pure speculation for now.
okay, let's try to bring this all together for the listener. We have growth, improving financials, technical momentum, looming catalysts, plus some spicy rumors. What's the investment thesis, and what are the final risks to keep front of mind?
First, the risks. Never forget them. Execution risk is number one. Can they actually scale the R2 smoothly, avoiding the production hell some others faced? That's the billion-dollar question.
And supply chains are still tricky, right? Plus the overall economy.
Exactly. Managing supply chains, navigating potential economic slowdowns, and just the inherent volatility of the EV sector, those are ongoing risks. And we mentioned the stock's high beta. It's not for the faint of heart.
So, bearing those risks in mind, how does the overall picture look? What are analysts saying?
The consensus among analysts is generally bullish, but cautiously so. Average price targets are hovering around, say, $14.11.
But some are higher.
Yes, the more optimistic targets, up towards $17 or even $21, are usually tied to those catalysts hitting. Strong earnings beat, positive R2 news, maybe that tariff relief.
So it sounds like there are maybe two ways to look at investing in Rivian right now, depending on your time frame.
I think that's fair. For a short-term trader, someone focused on the next few months.
Yeah.
Rivian looks like a classic event-driven play. You're essentially betting on positive news from the November 4th earnings and the R2 updates driving the stock higher. It's about capturing that catalyst-driven upside. High risk, potentially high reward in the near term.
And for someone with a longer view, a multi-year hold.
For the long-term investor, the appeal is more structural. You're buying into the broader EV adoption trend, betting that Rivian's strong brand and that premium adventure niche will endure, and trusting that management will continue to improve the financials as they scale. It's a bet on compound growth.
So it really comes down to execution, doesn't it?
Ultimately, yes. Rivian's near-term fate really hinges on converting that big cash pile they have and all the R2 excitement into actual, tangible proof of execution. Can they build the R2 efficiently? Can they improve those margins?
The potential is huge if they get it right in that specific market segment.
Enormous potential reward, but the execution risk remains significant. That's the trade-off you're looking at right now.
The question for you to mull over is this. Considering the management has shown discipline by cutting costs and restructuring debt, are they now positioned to execute the R2 launch more smoothly than their challenging R1 ramp? Your conviction rests entirely on their ability to learn from past manufacturing struggles.